Hello everyone, welcome back to my YouTube channel. So do you also want to reach to 1 lakh salary and more than that on a very intermediate level of your career? If yes, then this video is for you. So basically, you need to understand one thing, that in banking in real world scenario, the most important concepts are the one which are very niche, and I only share those concepts which are actually niche. You will not get those concepts anywhere else. Okay. So expected credit loss modeling is going to be covered in this video. But as you can see on your screen, that allowance model is the main target there. Okay. So before we begin, it's important to understand how this is so important. In real banking systems, the entire credit risk framework is divided into two layers. First is the model development layer. So let me mention that also. So first layer is your model development layer, which is highly statistics based, and this involves like PD, LGD and EAD. These models use technique like logistic regression, fine tuning, feature engineering, weight of evidence, all those things. You might have heard of all these values, right? And validation metrics such as Gini coefficient and then KS, all of them. So these are one layer. But today we are not going to talk about this. We are going to talk about the second layer. Now, second layer models are also equally important, and these are very high paying as well. Okay. The second layer is the ECL or the allowance engine, which takes these pre-built inputs and apply business logic to calculate expected loss and run the scenario and generate the report. The code we are building in today's video belongs to this second layer. Okay. And I will show you the real SAS code also will execute that. When the focus is on calculation and provisioning rather than model development, that's where your allowance model comes to picture. Okay, so now let's quickly move on to the SAS without wasting any time. So let me just make it full screen. Okay, so I will give you a brief of SAS code also and what we are doing at each step. So basically, all these models are generally built in SAS because SAS is a tool widely used in all the banking sector, although it's migrating from SAS to Python, but these are in SAS. Okay, so step one, we are creating just dummy data. We start by creating a data called loans using the data step you can see on your screen, where we input sample loans using the data lines, which is pretty much visible, right? It's a small set of data. Each row represents a loan with variable like product, and then you have like balance, basically income and credit score. Default flag also is there in terms of value. So you can see all these default flags 0, 1, 0, 0. These are the default flag, and your last variable is your collateral. So basically collateral value is your last variable here. Now this step sets up the base data set that will drive the entire model for us. That's going to be the building block of the code. So primarily you can see the difference, like PD model is the step 2. So logistic regression is the simple mathematical formula which I'm applying. In SAS you have simple proc logistic which is applied here. So probability of default model, where default flag is the target and income, credit score, balances are your predictors. So using the output statement in the code, we store predictive probability in a new data set called PD. You can see that this is your new data set as a value of PD, okay, which becomes a key input for your expected credit loss. So simply you have calculated the PD value, no statistical approach used in much detail. So just calling the proc logistic directly. So we are not implementing or building a statistical complete model because SAS is very efficient from that angle. Okay. Now, in the next step, when you see, so LGD is very easy here. You can see simple business logic on line number 33, right? So then we are creating basically here the LGD data using the data set and simply applying a if else condition. If collateral exists, we assign LGD as 0.4, otherwise 0.9. Simple. That is a business rule. This basically demonstrates how business rules are implemented directly in the code rather than calculating them using the statistical versions. So these are directly coming from the business teams. The business teams are giving you the value and then you need to simply code that. Here I am just giving one value, but in the real life scenario, they will give you a complete table where there will be so many multipliers maybe there. Okay. The next step, which is very important again, EAD calculation, exposure at default. In this step, we are creating EAD data and then we are assigning EAD equal to balance. So what this simply does, this simply transform how exposure is defined and carry forward for further calculations. There is no statistics again involved here. It's simple business logics. These are given by business. Now you can see the ECL. So we need three component PD, LGD, EAD. Now we have the ECL, which will be calculated by the using of these three value. Now we simply compute ECL, ECL data. We created this particular data set, and then using the formula ECL equal to PD, LGD, EAD. Simple. This will be calculated for each of the row. Okay, I hope you understand that in real life scenario, when you have 10 million customers, so it would be running for each row and it will calculate a value of ECL for all those 10 million rows. So this combine all previous component into a single risk metric at the loan level. All of you can see that. Simple. Now next step. Now we have calculated the ECL. So what is next? Like scenario creation. What is that scenario? We are defining the scenario that what is the, so you might have heard of stress testing. So you need to implement the stress testing model here, like base condition, then you have like mild, and then you have a severe. So there is a condition which I'll give you as an example. So base scenario, when the economy is doing good and all the macroeconomic factor, everything is fine. Then you have a mild stress. Let's say there is some small war at any small country or something like that. That will not impact the whole world. But then comes a severe scenario, which is like your some big issues like COVID was there, right? So COVID impacted the whole world. So in that case, bank need to keep enough money in their pocket so that they can sustain even if the people are not paying the loans. So basically, in the step number 6, we extend the model by creating the scenario underscore data, where we define base, mild, and severe, as I told you, by increasing PD by 20 and 50%. That is again defined by the business. You can see that. So this multiplier is given by the business. That's the simple step. That's why it's called the allowance model. We are trying to calculate the allowance which we need to keep in our pocket without using any statistical technique directly. Okay, allowance will help you to actually calculate that capital amount which bank should contain. Now, corresponding ECL values are recalculated values. Some of the bank call them recalculated value, and showing how stress testing is implemented in this particular code. All these lines, so you can see. These are the stress testing scenario. That's why you will hear that in all the allowance models, stress testing is being used. Now we have calculated the PD value, like how much the probability of default will be in all the stress scenario. Now we'll move forward towards the benchmarking. Now in 6.2 benchmarking, we create a benchmark data to compare result by setting a zero loss benchmark, right? And calculating gaps like gap zero, gap stress. This basically helps qualify how much risk exists under normal and stress conditions. So we calculated the PD value. Now we are calculating this. So again, benchmarking is a very important step. Okay. So simple SAS programming. If you don't know SAS programming, I would say this is your first video on my channel. So I would request you to go back to my small playlist on SAS. You will understand this code very easily. Now let's move to step number 7. So portfolio aggregation. What I have done in this particular step, using the Proc SQL, we aggregated ECL value across all the loans to calculate total portfolio level loss. Okay, under different scenario which we calculated. If you can see, base, stress 1 and stress 2. This steps translate loan level calculation into business level insights. Simple. That's what business want to know. In each of the scenario, you tell me the expected credit loss. That's my whole agenda here. So portfolio aggregation. After portfolio aggregation, the main step comes. So we create the allowance adequacy here. So what I'm doing, I'm calculating an adequacy, okay, data set, which you can see already, where we adjust ECL with a 10% more buffer and calculate variance. Okay, so based on the threshold, we classify this into green, red and yellow scenario. Okay, which is helping assess whether provisions are sufficient to absorb the shock by the economy or not. That's the whole goal. Okay, because bank always want to understand that how much capital we need to hold to deal with any kind of stress scenario. That's the whole and soul. Now you have the final version in your hand. You have the allowance values. Okay, so this will give you the ECL value across all the different scenario. Now in the step 9, you can see finally I'm just creating a final report. That's how we report, like in this in the banks, in the real banks, in any of the company you would be working, you will see usually we will send the data in reports. So I'm using proxy equal to group result by products basically, and calculate total ECL for each segment. This produces a clear report that highlights risk distribution across your loan types. You can see that scenario wise. Now stress testing is very important here. You should know stress testing. If you don't know, please check my video on stress testing. That is very important. Okay. So on this video, how you calculate end-to-end ECL pipeline work in real life scenario. This was a small example. You need to implement in real world. Okay, this line of codes are very small. In real code, you will see it will be 1000, 2000 lines also, because scenario would have so many conditions. So that is something you need to understand. Now, this video was enough to understand what is the allowance model. Okay, starting from raw data and going all the way till the final reporting. If you want to grow in credit risk banking analytics and reach to the high paying roles, this is something you should know. Understanding and implementing these kind of practical workflow is actually going to be a game changer for all of you. Now, on that note, I would like to mention that you can download this code from my GitHub repository. The link will be there in the description box, but make sure that you understand the concept. If you have any question around this, please ping me, or you can put your comment. I can reply to that. But again, stress testing and allowance teams are there in all the banks. So if you have a focus where you don't want to learn so much of statistics, you can move into the allowance or model validation side of this particular portfolio, where you're just calculating the allowance using the business rule, not using the statistical formulas. Okay, on that note, I would like to wish all of you all the best, and I'll see you in the next video. Thank you so much. All the best, guys.